Are stocks about to crash? Nvidia stock is giving us a really big warning. The last time this pattern played out, we dropped into a bear market or by 20%. So Nvidia is now down on Friday. It's also down in the last week. And you might be wondering, is the red we see here going to feed through to the rest of the market? Well, that's exactly what we're going to talk about. The first thing to note is that there was 5.5 trillion reasons why the move might have been amplified into the Friday close, notably here on Nvidia. And I do want to come back and look at this pattern, but very simply put, we have a failed breakout. The same thing happened here. We were looking at this pattern for quite some time, and we just said that we want to see hollow candles, which means the expansion continues. That's the same thing that happened here for 11 weeks in a row. Over here, I think we notched 8 in a row. However, the warning that I'm laying out in today's video is very simple. After we stop getting hollow candles like we do right here, we actually also get a failed breakout. And there's only one thing that needs to happen for there to be follow through. So stay tuned, and that's exactly what we're going to talk about today. So if we think about this one-day move, which seems to have people on edge, again, there's 5.5 trillion reasons why the moves were amplified. And this is one of the biggest OPEX on record. So what does this really mean? We get quarterly expiry every 3 months. We get rebalancing. We get options that expire. So that's what really happened on Friday and really into the last week. So let's think about this. If there were 5.5 trillion options that expired, what happened in the last 3 months? Well, the big blocks have been on fire. So Nvidia is up by 38%. Yes, they managed to burn those calls a little bit. If we look at the last 1 week, yeah, it's red here. But man, they paid out a whole bunch of money. This stock is on fire. It's the third biggest company in the world. It's up by 40%. So I would say that, yes, the moves are amplified, but that also means we can have upside volatility, which is exactly what we see here. The rest of the market does not look super unison or largely green over the last 3 months, though. So here's where I'm noticing 2 images from the weekend. And the first one here is just that we have this thing called the common man CPI, and then we have the employment cost index. So what this really means is that your things you buy every day, things like food, energy, shelter, utilities, insurance, again, things you need to like just basically be alive every day. Well, those costs are going up more than what you're actually making. So yes, people feel poor. I understand that. But here's the other side of the coin. Tech stock valuations today versus where we were in March of 2000 when we peaked. It's 30. We're about half, right? We're trading at about, 60% of what we used to in 2000. So yes, the average person feels poor, but some stocks are doing incredibly well, as we just showed you. And at least for now, we're definitely not into a mania. Why? Look, we're at 30.8 today. That's the current tech sector valuation. 55 is where it got frothy. Again, the saying is that the market can remain irrational longer than you can remain solvent, to the upside or to the downside. So people don't really believe this move if they're watching from the sidelines. If they're in it, they're like, oh yeah, to the moon, to Jupiter and beyond, right? Armageddon, let's go everywhere. Let's go to space. So what I'm basically saying is that we want to be mindful that there is basically a tale of 2 economies, a tale of 2 stock markets. This right here is basically the Russell, right? Way down in the dumps. No one likes this thing, right? It's beaten up, it's hated, can't catch a breakout, and it's kind of stuck here. It hasn't done very much. Versus these mega caps, which are just absolutely on fire. If we look here to like XLK or QQQ, look, but there's that same pattern here, which I'm worried about. And we're going to come back and look at that in a few minutes here. Today's video is not going to be all that long. But if you guys don't mind, I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, I would greatly, greatly appreciate that. All right, so I mentioned that there's been a lot of money expiring, or again, a lot of reasons for the bears to show up, to stomp the chart down. They got fear. We were in fear a week ago. We were in fear on Friday. Why couldn't they take us down more? That's really what I'm wondering here. And the average commenter on YouTube is still largely saying, I don't feel rich. The economy is not strong. Yes, again, the market is going to be looking for what is actually happening out there. The Fed slices and dices the data to make them look good. That's why they look at PCE and not CPI. Why? Because it usually is a better number for them. Remember Supercore? They talked about annualizing a Supercore number. Well, they stopped talking about that. So what this really means is that the costs you're seeing at the store are higher than the money you're making, which means you feel more poor. And if you feel poor, you think everyone else feels poor. Well, that's not how the economy works. The rich get richer, the poor get poorer. So if you're feeling more poor, it doesn't mean everyone else does either. Look at stonks, they're way up. So why? Well, let's think about where we're going to go from here now. So we understand things are more expensive, but if wheels in motion tend to stay in motion, and if we know after an incredible May we keep going up, here is what I will be watching for this week. This thing has been on the calendar for like 3 weeks in a row. All I care about is this. I care about what happens on Friday. The data's fairly weak as we look into the first part of the week. I think consumer confidence will matter. This is a revision. Jobless claims might matter, but here's all I really care about. Why? I'm going to show you a pattern in a minute. And because we get this number coming out on Friday pre-market, it's likely going to drive where we close out these weekly charts. Notably, Nvidia, which is already giving us the warning here of, again, we have a full candle. It's red. It's a failed breakout. Yep. What we're looking for next week would be a weekly lower low, and then ideally closing below the low here. After we got that second candle, that was kind of the kiss of death for Nvidia. It just kept going down after that until it bottomed out. That's actually a 20% correction. Then we got higher highs, higher lows, and the expansion took back over. But this pattern's not just happening on Nvidia. If you look at SPY, it's really close here. I'm talking cents. We almost have a failed breakout. Looking at QQQ, man, it's even closer. We're barely green on the week, 99 cents. So if by Friday we're going to get a bearish move, we'll have the confirmation here. I'm not sure what this headline number is here for core PCE, but we do have the month over month coming down to 0.1. This is the Fed's preferred inflation gauge. I think this number will be interpreted bullish. I think this number is also going to come down. So what does this really mean? All right, now let's look at some charts. And today's video is likely going to be shorter than previous weekend reviews because, frankly, I'm outside enjoying the summer, and so should you. Charts get a little bit more boring in the summer. Why? Because people are outside, right? They go to the Hamptons. So in the summer, we normally see volume really drop off and price action starts to stabilize, meaning we don't really get as big of swings. Is this year going to be the same as before? That part, I don't know. All right, now let's go look at some charts here. So let's start with NVDA, right? NVDA or Nvidia, right? The ticker is NVDA. Anyways, going here, we note that if the pattern's going to play out, all we need is this right here. We need lower highs, lower lows, but notably closing below the low. And the reason why I say this is important is because by closing at or near the low of the candle, we usually have follow-through momentum, which will manifest into the next candle. So what I would expect is that Nvidia will make a weekly lower low. But the question is, by Friday, are we going to rally back up or are we going to fizzle and close below that low? Look right here. It's exactly what we did. So if now we got the first piece of evidence, a crash, right? Because this is actually a crash here, 20% could be happening. Well, one candlestick's not a pattern. Why? They're still playing defense. We still have higher lows. So if bulls are playing defense, but now they're failing a little bit on offense, we need to see them lose defense. We got to see lower highs. We got to see lower lows and closing below that low. So if we go here to SPY, it's very similar here. Because we have basically a shooting star, an inverted hammer, and we're only cents over last week's high, I'll make these full so it's a little bit easier to see. But same thing here. If we're going to get a weekly lower low, do we close below it? Why? Well, look what happened over here, right? We get a reversal pattern, close below the low. There's our crash. That's what happens, right? We talked about this pattern many times. One candle is not a pattern. We actually need 3 in order to do that. We need a set of lower highs, a set of lower lows. But if we're going to get a warning, we're probably going to get that next week. We're probably going to have a full candle. We're probably going to go below this low and probably close below it. Finally, same thing here for the NASDAQ. So as I mentioned, by closing at or near the low of the week, which is exactly what we have right here. If you look at the size of the candle, we're definitely closing closer to the low. And because we're just above the high right here, here's what pattern could play out in hindsight. Shoulder, head, shoulder. So if next week we open up soft and we don't rally and all we get is a high right there, I'm going to say that's a head and shoulders. Where support? Well, it's a lot lower. It's at a boot, 465 to 460. So if we're getting a warning of dropping by 15 points, yes, we're going to see that evidence. Let's be mindful of it. And the same thing is happening on a lot of charts. Let's quickly look at MAGs too, because same thing here, failed breakout. So if chips lead tech and tech lead SPY, are we getting that same warning on most ETFs? Yes, we are. Chips are leading tech, which are both in failed breakouts. The NASDAQ as a whole and the S&P as a whole are holding up though. So that's it for today's video. Nice and short and sweet. If you want to watch more, click on the left, or maybe you want to subscribe on the right to come hang out with me at 9:15 a.m. tomorrow. Thank you very much. I'll see you on the next video.